Good morning. Let's do it, folks. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Monday, the 9th of December. As the blue box in the corner tells you, apparently I'm JD Durkin. Opening bell rung just moments ago here by Master Brand Inc. Congratulations to them. Let's take a look at how the major averages are kicking off this shortened trading week. Stocks are, I don't know, what are stocks doing? They're down fractionally right now. That's about what we expected. This after notching their second straight week of losses as recession fears continue to mount. You hear the R word in every business story that you read or business CEO interview that you watch. Concerns over an economic slowdown were renewed after the Federal Reserve raised interest rates again last week and upped its forecast for future rates. Not so much the short term, the long term, rates going higher and staying there for longer. Let's take a look for what is on tap on this Victory Morning broadcast. Yes, you know I love my New York Football Giants. What are we doing on the show today? We'll tell you what to watch as Wall Street kicks off the second to last trading week of the calendar year. We're already at the end of the year. Sources familiar tell me yes. Plus, Tesla investors, did I skip one? No, we're right. Tesla investors calling for a new CEO as Elon Musk continues to stir controversy at Twitter. Good luck figuring out what's going on there. And finally, Sam Bankman-Fried is expected to agree to extradition in the U.S. as he faces a series of charges relating to the collapse of FTX. What a story. To learn more on that story and so much more, we welcome our senior editor, our chief markets correspondent, Mr. Martin Baccardax. Martin, I hope you had an outstanding weekend watching what really may be the greatest single weekend of sports that I remember in many, many years. It does not get better than this. We will talk about that before we're wrapped up today. But here for the first time since September, we're coming off our second straight week of losses. What's top of mind for you and you think for many investors as we head into what is a pre-holiday week here on the street?
Yeah. Feels like a bit of a reality check for markets, doesn't it, JD? And it's only really sort of crystallized over the past couple of weeks. I think there was a great deal of momentum heading into December and the assumption that the worst was behind us and the markets were going to find some traction going into the final weeks of the year. But we simply haven't seen that materialize. And I think that irrespective of that softer than expected inflation reading for the month of November, what we are now seeing is just a string of weaker economic data points. And that is just underscoring the risk that people have had with regards to a near-term recession in the United States, the world's biggest economy. PMI data Friday, for instance, was quite weak. The services sector component of it, which basically tracks the opinion of purchasing managers across really the most important sector of the U.S. economy, indicated a sharp contraction in activity in the month of December. And those numbers generally point to significant overall GDP decline. Now, we're not there just yet, but the track record is pretty solid. And what we're seeing in the bond market, of course, illustrates a similar concern. So I think, JD, the weakness is more about the fact that we are understanding better that the economy is weakening in a way that maybe we didn't understand even a few weeks ago. And at the same time, the Fed has told us in no uncertain terms that they're going to continue raising rates into that weakness because they see the inflation fight as their most important task. You put those two together and you have what you see in the markets today.
Since you're a student of history, we know that Fed Chair Jay Powell, I just want to ask one more on the Fed, if you'll permit me to. He frequently says, the historical record strongly argues against prematurely loosening policy, and we will stay the course until the job is done. To me, I'd have to imagine the history he's worried about repeating is the Arthur Burns era, this idea of sort of forcing the U.S. into a recession in the 70s, having unemployment spike dramatically from something like 5 to 9% and then backing away. That's what Arthur Burns did years ago. Is that your understanding of the history, that Chair Powell is very focused on not repeating, or is there a bit more that predates all this that you think is top of mind for the leader of the Federal Reserve?
Well, I do think that there have been some more historical examples in Europe that might give Chair Jay Powell pause for concern. There's been a couple of missteps with premature hiking and premature cutting from previous generations at the European Central Bank, Jean-Claude Trichet being probably the most prominent example. But ultimately, JD, whilst I do think you're right in that historical parallel, I've long maintained that I just don't see these as applicable in the global economic context in which we sit today. When you look at the strength, the growth rates, and the contributions of the so-called BRIC economies, Brazil, Russia, India, China, over the past 2 decades, they pale into insignificance when you are comparing their activity levels to the kinds of tightening that we saw in the 1970s and indeed the early 1980s. We simply didn't have the world's second largest economy preparing to export deflation into the global economy on a month-on-month basis. That's precisely what's going to happen if and when, well, I won't say if, but ultimately when China reopens and its supply chains are ungummed and its export machine is revved up once again. So I do think to some degree that the Fed is focused on its inflation task while not necessarily giving enough credence to the implications of supply chain disruptions and how that has affected overall CPI rates. I think it still believes in the way that the monetarists do, going all the way back to Milton Friedman in the late 1960s, that inflation is always and everywhere a monetary phenomenon. Now, I simply don't accept that anymore. I do not believe that that is the case in a modern global economy. I think we've seen evidence of it in Japan, we've seen evidence of it in Europe, and we've seen evidence here in the United States. When we only had the spike in inflation as a result of the pandemic disruptions. Prior to that, we were pumping money year after year on a fiscal basis with loose monetary sort of thresholds. And we didn't get a sniff of inflation. It didn't materialize in any major economy around the world. We didn't get it until the supply chain disruption came as a result of the pandemic. So I think to some degree, many people within the Fed are clinging to what seem to me outdated concepts. And as a result, I think this is why we're getting the market pushback to its 5.1% peak Fed funds rate consensus.
That's a great perspective and important context there, Martin. I do want to ask you about earnings ahead for the week, as people say, wait, there's earnings this week? There are a few notable names. Which ones should we be paying close attention to, and what clues could those companies and the subsequent information give us into what companies may be expecting as Father Time rips another page off the calendar and we head into 2023?
Indeed. I think we actually have three really important ones, JD. I think first and foremost is Nike, which is going to report after the close of trading on Tuesday. We'll understand certainly what they anticipate with respect to consumer demand into the sort of, the beginning of the holiday season and where we're headed into the start of next year, but also what they are seeing with respect to the supply chain situation in China, because they are so reliant upon that in order to get their goods where they need to be. They have attempted to wean away some of that dependence over the past couple of years, but they are still very much a China-dependent stock, at least where that is concerned. So what they have to say about that is going to be exceedingly important, as well as the implications for the US dollar, which has faded, but is still at multi-year highs against a basket of its global peers. FedEx is going to be the second one, JD. They'll also report on Tuesday after the bell. I think that one's really important, obviously, as a result of how we see it as a barometer of economic activity, particularly at the business end when it comes to shipping and packaging and everything else like that. It's very much at the bow of the global economic ship, and what they see going forward is incredibly important. And then we'll get Micron Technology on, I believe it's Thursday. And of course, that's going to have tremendously important implications for the chip sector, which is suffering a whole host of issues, certainly those related to China supply, but also with the ongoing sort of trade disputes that we're seeing between Washington and Beijing, the restrictions on exports to China as a result of those restrictions, and the anti-competitive behavior that the U.S. has accused China of exhibiting. So we'll have really important declarations of outlook from companies across three different sectors, each of them different, but each of them equally important. So it's interesting that they're all coming in this final week, because I do think they will have a tremendous impact on our sentiment going forward.
Yeah, of course, we did have the Micron CEO at that event in Arizona a couple weeks ago, alongside people like Tim Cook, President Joe Biden, to talk about the role of Taiwan Semi. That was a really fascinating conversation you and I had there, underscoring the importance and the urgency over that topic. I do want to get your sense here, as we do have, somehow it's already December 19th, for anyone sitting there and saying, where should I focus for these last couple of weeks between now and the end of the new year? Excuse me. Hello, Mondays are tough. Of course, we recently had the CPI report, the December Fed meeting. Those things are now behind us. Any other big factors that jump out to you, Martin, to be of high consideration for the remaining days in this calendar year?
I think those earnings are going to be the most important, JD, because really what we're seeing now is a great deal of discussion about the potential for an earnings recession into 2023, irrespective of what happens to the broader economy. Morgan Stanley published a paper this morning, in fact, that talked about The S&P 500 earnings at about $180 per share by the end of next year. That's about I beg your pardon, that's about 1/3 behind the current consensus of $231 a share. So that's a really significant discount to what the rest of the market is seeing. Mike Wilson, the author of the report, is essentially saying that we are not correctly understanding the headwinds that American companies are facing, particularly at the consumer end. And as a result, that's going to hive off earnings in a significant way. His worst case scenario, or at least the bank's worst case scenario, is we could get another 20% decline for the S&P 500 between now and December of next year, taking it all the way down to close to 3,000 points. That's certainly an outlier. There's no question about it. But I do believe that we are going to see that kind of recalibration, if not this week, certainly into the final trading days of the year and the 1st of January. I think ultimately we are going to see a differing set of opinions with regards to earnings generation. First quarter earnings, the last I looked, fourth quarter earnings are likely to drop by about 5.7% when compared to last year. That's when you take the energy sector away. So we're already in decline with regards to earnings generation. And if that were to repeat for a second consecutive quarter, or potentially even a third, then we are absolutely in earnings recession, and Mr. Wilson's prognosis will become a stark reality. Now, you have to remember that will immediately elicit at least a thought process amongst Fed governors as to whether or not their tightening cycle is legitimized. So there's often circuit breakers to these movements with respect to the bond market, currency markets, and Fed policy. But I really do believe that it won't be long before that recalibration begins. We have assumptions that are significantly lower than we are now in terms of earnings generation, and that's going to put added pressure on stocks into the start of the year.
I do want to ask you the latest on the greenback here this morning. The U.S. dollar a bit in a retreat mode on this Monday morning. What's behind the pullback?
Not a great deal of liquidity, to be perfectly honest, JD. We've seen more volatility in bond markets this morning than we are seeing activity in the currency markets. I think probably the most significant driver today is the fact that we had maybe a slightly better optimistic tone in a key European business survey conducted by a company called the IFO Institute. Basically, it shows that the German companies, which of course operate in the biggest economy in Europe, are feeling a little bit more optimistic about their prospects, and that may solidify the European Central Bank's hawkish tone. We're also seeing very nascent reports of the potential for an interest rate change in Japan, and that would be exceedingly important. There's talk of a potential hike into 2023. Again, very, very early days, and a lot would need to happen in order for that to get executed. But we saw a big jump in 5-year Japanese government bonds overnight, and the currency firmed up as well. So when you have the stronger yen and the stronger euro, the two biggest components of the currency basket, you're going to get a corresponding pullback in the dollar, and that's exactly what we saw.
I do want to ask you about the COVID situation in China remaining still uncertain. Some of the latest developments that you're paying attention to, I wonder, because obviously we've been having this conversation on and off for quite some time with regards to, the headwinds that CEOs here cite and around the world, and also some recent reopening developments. So what do we know in terms of what that conversation has looked like and how it might matter here?
JD confirmed the first two COVID since the early part of December. Now, the pandemic onto its 3-year anniversary, there has gratefully been very few deaths in China, the world's most populous country. I think it's about 5,200. Obviously a titanic number in human terms, but in context, rather small when you talk about a 1.4 billion population. But of course, it does raise two questions. Firstly, are the numbers accurate, and is China being truthful? Because the last thing they're going to want to do is have panic about reopening prospects, just as they got through panic over lockdown sort of restrictions. So if the government has basically bowed to public demand for loosening conditions, I think most epidemiologists will tell you the result is going to be a wave of infections and, unfortunately, an increase in fatalities. It will be interesting to see how the government sort of reports that and whether it acknowledges it in the same way that outside observers do. And that, of course, is going to have implications as to how quickly they can get back to full strength, what it means for supply chains, certainly in the tech sector, but indeed across the whole of the export space. So there's still lots to talk about in the China story, and we are rapidly approaching the Lunar New Year in early February, when there's going to be just an enormous amount of travel, people heading from cities back to the countryside to visit families and to celebrate and to basically enjoy their version of Christmas. And that could elicit another wave of infections and unfortunate fatalities as well. So the story is long from over, and the Chinese economy is still looking susceptible, even when we talk about it being 3 years on from the first infections in January of 2020.
Martin, Apple specifically has made a lot of headlines as of late for some of its efforts to, I suppose I would say, decrease its reliance on China. And I wonder if there are other big names. Obviously, when Apple makes a move or an announcement, it is going to, understandably, earn disproportionate coverage. I wonder, are there other companies? Have we heard that? Is this a bit of a more common refrain in the U.S. business world than we might otherwise believe, seeing as how when Apple speaks, everyone tends to listen?
Well, certainly Apple has been at the forefront of that. And I think really what we've seen with regards to the CHIPS Act, which was passed over the summertime and basically allows for some government funding alongside private investment to get chip manufacturing going here in the United States. That's an indicator of how tech companies would like to wean their dependence off China as well. I mentioned Nike. They're also trying to ramp up production in Vietnam and other places in South Asia as a result of their ideal situation where they can be less reliant on China and the vagaries within the government of Beijing on their global exports. Adidas is doing the same thing. These companies have, though, for a number of years, JD, tried to diversify their supply chains. It's easier said than done. Of course, it takes a great deal of capital expenditure, a great deal of time in order to get not only the plant and manufacturing facilities up and running, but to get them fully staffed and to get them operational in a way that they can seamlessly blend in to existing supply chain dynamics. So it's not the thing that we look at in a 1, 2, or even 3 year period. It can be often much longer. But it's certainly true to say that the process has started in a way that is probably the most accelerated we've seen it in at least 2 decades.
All right, I do want to pivot now, and I do want to ask you about Tesla, but in a relatively, well, not relatively, a very connected story is Twitter. Right now, you can't really talk about one without the other. It's like that old Frank Sinatra song, you can't have one without the... Was that Sinatra? Yes, The Love and Marriage. That was the Al Bundy theme song, but I think it was Sinatra originally, if I'm not mistaken. So you can't have one without the other. Let's talk a hybrid, Twitter and Tesla, if you're game. I want to start with this Twitter poll. I don't know if he's being real. I can't imagine he is, but who knows? He also said he doesn't want to be CEO, but he did ask on a Twitter poll if he should step down. The majority of respondents, at least last time we checked, say yes, you should step down. We don't want you to do this job. Is he just kind of trolling here? How do you actually see him playing this out now that at least this is out there? Just making it up as he goes.
He's most definitely the most mercurial CEO I think we've seen in American corporate history. What he does tend to do, JD, at least from my estimation, is he will run these Twitter polls in a way that he knows will generate the result and support the decision that he's already taken. So I think the fact that he put that poll out there and said he would abide by it indicates that he was already planning to step down or at least hand over control on a day-to-day basis to somebody else. And he can demonstrate his democratic bona fides by producing the results of the poll, which he knew was going to generate the yes answer. I think 57.5%, as you say, indicated as such, and there were about 17.6 million votes. I thought there'd been more, actually. I mean, his Twitter account itself is 122 million, and there were loads of people, of course, on the platform enjoying the World Cup match and enjoying the Sunday football matches here in the United States as well. So I would have thought there might have been more participation, but the result is pretty straightforward. And I just think indicative, JD, of the lack of patience that Tesla shareholders are having as a result of his divided loyalties and divided intentions, and the fact that the Twitter situation is going to take a diplomatic approach in terms of not only engendering trust with respect to the content creators, but also the advertisers. And I think we can be blunt and honest in saying that that is not Musk's forte. He is someone who, by sheer strength of will, by hard work, and by vast intelligence can drive his staff to outperformance. I think that is just simply beyond argument. But it doesn't work in every situation. And I think you're looking at a situation now with Twitter where you do need somebody with a slightly more deft touch, not only with respect to employee relations, but again, with regards to talking to advertisers, talking to content producers, talking to moderators, and coming together on a consensus that works for everyone. He is more binary in his decision-making than is probably required in this situation. And therefore, it might make sense for him to hand the reins to somebody else who has a bit more of a nuanced and collective approach. That, to me, JD, is what the platform needs.
Of course, Tesla stock rallying a little bit. I was just checking the latest numbers. It is up here. Let's do this in real time, folks, because we're live. That's how we roll. It's up 2.4% right now.
Okay.
What are the other considering factors over the ongoing Twitter saga, Martin, that you think Tesla investors will be closely paying attention to? I just think it's funny, by the way, if we were to go back to like September or so when you and I started doing the show, and you told me that this would be the type of conversation we were ending the year on, I was like, oh, absolutely not. There's no way he's actually going to go through and like have Twitter and have this whole thing, but here we are.
Yeah. He wanted it, and then he didn't want it, and then he was forced to buy it, and then he said it might be close to bankruptcy, and now he says it's had the best day in years. So he goes back and forth, and again, that's indicative of his communication style. I don't necessarily mean to attack him for it, but irrespective of that, it does have implications for Tesla stock, and they are quite serious. I think one of the implications, JD, is the fact that if the Twitter platform is going to engender mistrust amongst the advertising base, that has profitability concerns. And that, of course, engenders mistrust with regards to the lenders. And the lenders, we have heard reports, are wanting further stock pledged against their loans in order to mitigate their risk. And that, of course, could trigger further sales of Tesla stock. We saw him selling 22 million shares last week, generated 3.6 billion. He sold 40 billion worth of stock already so far this year. If the lenders want more stock pledged against the declining value of their loans and bonds, he may be forced to do more share sales into next year, right after or right before the fourth quarter earnings and delivery numbers, and that could have significant consequences. The stock has shed hundreds of billions in value so far this year. It's actually elicited rare criticism from some of his biggest defenders and indeed some of his biggest individual shareholders, which is something we really haven't seen since the inception of the company in 2010. So the fortunes of the two companies are absolutely tied together, even if they are working in markets that really don't have any particular correlation.
Can we see more analyst downgrades? Then we got one from Oppenheimer, citing Elon Musk's current handling of Twitter. Is this kind of what we're in for, maybe? I mean,
I suspect so.
We like stability. We don't like erratic behavior, but here we are.
Yeah. The stock is really expensive, even with the biggest drawdown from peak to trough on record, and the fact that the stock is trading somewhere around the lowest levels in 2 years. It's still a very expensive stock on price to earnings basis, much more expensive than the broader market, and significantly more expensive than Ford and GM, which are really starting to get traction, not only in EV production, but also in the broader zeitgeist. I thought it was telling last week, JD, that Ford was comfortable enough raising the prices of the F-150 Lightning, their electrified truck. The Ford F-150 is each and every year the most popular selling car in the United States. And if I'm not wrong, it might be the world, but certainly in the United States. If they are able to get the kind of traction and consumer demand for the electrified version, then they could really present a significant challenge to Tesla, at least in the domestic market. And the fact that they were comfortable enough raising prices into that demand tells me that they're much more confident, maybe than they were even just a few months ago. So the competitive challenges are increasing. The stock is exceedingly expensive, and Mr. Musk's attentions are spread across a number of companies. So yes, is the answer. I can absolutely see there being downgrades going into next year.
All right, and finally, before we head into rapid fire here, any other notable headwinds for the company, for Tesla, outside of the Elon Musk saga, which of course takes up most of the oxygen?
Well, he's cutting prices in China, isn't he? And he did it twice. There were price cuts in October and some incentives put into place in December as well. And if we are to see the worst scenario materialize in China, where the economy reopens too quickly, infections spread, and fatalities escalate, that would, of course, create a significant headwind on both the production side and the demand side in the world's biggest electrified car market. So he's not out of the woods yet with regards to China. There are still issues in ramping up full production in Berlin and Austin, even though there was some targeted leaks about Austin coming online faster than expected just last week. The PR machine is up and running as far as that's concerned. So yes, I think that ultimately Tesla, even if it strips away the Twitter overhang, still has that China headwind, which is a long way from abasing.
All right, time now for our rapid fire section with the remaining moments here in our broadcast. First up, why is the European Union coming after Meta? EU regulators, what's up here?
Another U.S. tech company in the crosshairs of the Competition Commission. Essentially, they're saying that the fact that Meta ties its online advertising marketplace to Facebook, its social media platform, that creates an anti-competitive environment and actually suppresses competition in the online ad space. It's so interesting to me, JD, the way that Facebook has essentially morphed into the world's biggest yellow pages. I mean, Facebook Marketplace and small businesses and everything like that are so dependent upon it. And I find myself on Facebook really only to do those kinds of transactions. I don't interact with friends and family on it in the way that I did a few years ago. So it's an exceedingly important component of their business. The EU says it's anti-competitive, and their laws allow it to fine Meta as much as 10% of its global revenues if they aren't in compliance. That could be, in a worst case scenario, 12 billion US dollars. I'm certain it won't be. There'll be multiple appeals process, and there hasn't really been a formal charge just yet, just an indication of one. Lots to go in the story, but it's a reminder that the world's tech policeman is not in Washington, it's in Brussels.
Yeah, and oftentimes Capitol Hill may take their cues from their friends on the other side of the pond to say, "Oh, look what they did. That was smart. Yeah, we should probably do that." And then like 3 years later, there's some bipartisan bill. They're like, "Oh, that was smart. Europe did it. They led the way. We should come up with our own version, and we'll fight about it for many years." We don't work very efficiently. Okay, number 2. My goodness, Sam Bankman-Fried will not fight extradition. We are expecting developments in that story today out of the Bahamas. What's the latest here, Martin?
Yeah, that's what you and I spoke about that last week, didn't we, JD? I would have assumed that the conditions in that Fox Hill prison, as reported, are just so terribly dire that he wouldn't be able to countenance the time that he would need to stay there in order to go through that extradition fight, which at the end of the day would probably fail anyway. He's going to come back to the United States, whether it's tomorrow, next week, or next year. I think that's a relative certainty. So I think he intelligently, or at least his legal team, just said, we'll at least drop that fight and marshal our resources to go against the 8-count indictment and the 115 years that he faces if convicted on all of those charges. As we understand, he's going to face a magistrate in the Bahamas this morning, at which point he will probably give up his extradition battle and will be on his way to the United States shortly after. I think that's the right thing to do. And again, it really is going to be the beginning of a very long saga in this story. I often say, I know the fraud charges are serious, and I have tremendous sympathy for those people who have lost money along the way. But again, from a human point of view, I'm finding myself sort of increasingly sympathetic to his condition. I think he has found himself now in a situation that he could not have imagined in his wildest nightmares. But they are indeed true, and he is going to face serious legal challenges here in the United States when he does return.
Yeah, federal prosecutors from the U.S. Attorney's Office in the Southern District of New York have said Sam Bankman-Fried, they allege he was the driver of, quote, one of the biggest financial frauds in American history. The prosecutors in this case have not pulled punches as they look to now litigate this both in the court system as well as, of course, the court of public opinion, which is also the game within a game for a lot of these things, and we'll see how that shakes out. Okay, third and final here, one of the things I've been most eager to talk with you about, my friend, the last day or so, the World Cup final. Was it the greatest game of all time? Wow.
It's the best international football match that I have ever seen, from start to finish. I think it delivered everything that we would have hoped. It's interesting, JD, that the sporting gods decided to give us this final for the ages at the end of a tournament which was replete with so much criticism over corruption, over bribery, over working conditions, over human rights, and all the rest of it. Each and every one of them legitimate. But what was staggering once again was for us to see in real time, live, en direct, as you would say in France, the power of sport. And the fact that when people are playing in pure competition, it raises our humanity to some degree to a level that, previously we maybe didn't fully appreciate. And I really do believe that's what happened in that match yesterday. It was flowing up and down the pitch, 90 minutes, played in good faith. The referee in complete control of the match for the entire time, including the extra time. And of course, it comes down, to that Shakespearean drama of penalties, and Argentina emerges the victor. It comes with the, of course, historical narrative of Lionel Messi finally reaching the pinnacle of the sport with his first World Cup, cementing his legacy as perhaps one of the greatest players of all time. You simply couldn't ask for more from a sporting event. And JD, to cap it all off, everything ended 4 minutes before the opening kickoff of Sunday football here in the United States. It was perfect.
It was perfect. 4 minutes is just enough time to get a snack, to get another beer, if that's how you were celebrating the sports Sunday, and to settle in at least here in New York for the Jets game at 1 o'clock. And then outside of that, I mean, just in itself, an incredible weekend of National Football League football. Yeah. I mean, Saturday and Sunday, forced miraculous overtimes, can you believe it style moments. And on a day like today, Martin, I think you and I are both grateful. Neither of us are New England Patriot fans.
Oh, my word. I mean, can you imagine the discussion in that locker room? Particularly, JD, after Belichick had made so much noise over the summertime as to how he didn't need an offensive coordinator, that they were going to do it, by committee on a collective basis. That did not work out terribly well. I felt such pangs of sympathy for the young man who threw the ball for the interception. And then, of course, from Mac Jones, who was essentially steamrolled by the Los Angeles Raiders player. It was kind of sad to see. But I was still nursing the wounds from the Dolphins' loss at the end of regular time on Saturday night in the snow for a third consecutive. So I wasn't feeling as much sympathy maybe as I might normally would on a Sunday. But JD, when you watch all these things, when you watch the World Cup, when you watch the NFL, and we're going into the college football playoff season, you understand why companies are prepared to pay so much money for these events, because they are really the lost dramas that we have in real time, in public life, anywhere in the world. Everything else is scripted, it's storytelling, we can watch it whenever we want. The only thing left that we can watch on demand at the moment and that we can't afford to miss are sporting events, and that's why they're so valuable.
Wherever NFL Sunday Ticket officially winds up, whichever bidder comes out on top. I mean, Mike, we've heard Roger Goodell. He said now is going to be about the time. I believe he said previously he'll announce the winner, so to speak, by the end of the year. We don't exactly know how that's going to shape out, but man, the rights for NFL distribution through the roof. And in a silver lining here for the holiday week, Martin, both your Dolphins and my Giants, if the season were to end today, would be playoff-bound football teams. A lot of things to be disappointed at, but a lot of things to be excited for. To say the less. You and I both wish. There are at least 3 more games here still on the schedule, but if they did, Dolphins would have the 7th spot over in the AFC. Giants would be in the 6th spot in the NFC. Let's hope that they both hold on so you and I could both have some playoff football to cheer for. Martin, a great show today. Hope you had an awesome weekend, and we get to do it again tomorrow, my friend. Thanks for making us smarter today, Martin. Have a great day.
You too, JD. Thanks.
All right, man, that's going to do it for the market close. Nope, market close. Hey now, market open from the floor of the NYSE. I told you, Mondays are tough, especially when you're up late watching football. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.